Family radio for a really great future. We're talking real money.
Welcome to Talking Real Money with Tom and Don. I'm the Don part of it. He's the Tom part of it over there. And I know you're going to be impressed because this program, these two people on this program have been heard on NBC, CBS, Fox News. We've won awards. We are we've written books. We have done everything we can do to make us appear to be credible and viable. We actually, though, have told the truth because we've actually been on.
Yeah, actually, in this case, it's true.
In this case, it's true. We've actually been on ABC and NBC and PBS and Business Radio Network and
we didn't pay
Money Magazine
to do it.
Money Magazine, but have you ever? Well, anyway, let me give you a phone number first before we get started. I got a little thing I want to share with you. Here's the phone number, 855-935-TALK. That's 855-935-8255 to talk about money because we want to help you. We do. And we want to show you how smart we are by telling you all these places we've been. But no, have you ever gone to the website of a financial firm, a financial advisory firm? Generally, they tend to be the smarmy kind, but who list on there. In fact, I went to one. There's a guy who does a local TV show after Face the Nation on the CBS.
Let me guess, he's selling something. That's my guess.
Oh, he's selling indexed annuities.
Really?
Yeah. And his website, it's called Strong Point Financial. And it says right here, it's got as featured in Yahoo Finance, CBS, Money Magazine, NBC, Fox News, ABC News, and more. He's got his own television show on the local CBS affiliate.
Oh.
Well, it's not really his. It's not really a TV show. It's like, well, we pay for this. You know, it's an infomercial.
It is. And it is what our friend Jason Zweig would call trust washing. Pretty interesting term. It's a great term.
Trust washing.
But it's fascinating the lengths people will go to. So in the case of the TV thing, I didn't even know this till I read his piece, that you hire someone for just a couple $100.
No, it's
to write a press release. Yeah. And then you send it out to your local TV station that generally picks it up and puts it up there somewhere because they need content.
They put it on their website.
Their website.
Yeah.
But then what happens is the aforementioned advisor writes on their website, says, as seen on ABC, CBS, Fox. They were never on the network. They were even allowed to visit the network, much less be on it.
And generally, and they weren't on the net. By the way, that's the other thing that needs clarifying. They're not on abcnews.com. They're not on NBCnews.com. Nope. They're on a local NBC affiliate in the middle of nowhere, Minnesota or South Dakota or something.
Yeah, Reno, etc. That's one. That's fascinating. But then he looked into this. Another one that's where people have used the National Ethics Association.
Oh, I had so much fun playing around at the National Ethics Association's website. I was there for hours this morning.
Yeah. Well, let's see. The 272 NEA members identify themselves as stockbrokers or financial advisors. Keep remember that number, 272.
272.
97 of them, which I think is more than a third by my math, had disciplinary history at either Broker Check or the SEC website. A third? Really? Mm-hmm. I mean, I don't know what the industry average is, but that sounds high.
I'm telling you, I was playing there today, and I went through the insurance and financial services people, and they're slimy. I mean, there's so many of them are so smarmy. It is not. And here's the other thing. I don't even know how this company's in business because I did the math. They have a total of 635 members.
And they only charge
$154 a year.
Yeah, that's
do the math on that. That's $100,000 a year.
Must be one.
I don't even know how they put up a website.
Laundry room working or something. I mean, that's a small. But listen to some of the 7 of them were fired for allegations of misconduct. 7 sanctioned by regulators for selling unregistered securities. 3 have been barred for life from the securities. I mean, I shouldn't be laughing.
Barred
but
for
it is
life
laughable.
is serious.
That's a serious. You got to do something pretty bad for that one.
And that's the thing, is that a lot of these, the best broker ranking or the best advisor rankings, these things, you can pay. These are pay for play. They're not legit. They're in many cases, totally illegit. 855-935-TALK. Call us.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Now, in the article we're talking about by Jason Zweig about these badges, these trust badges, these trust washing that happens with these companies, the National Ethics Association, or the NEA, which I thought was the National Education Association.
I did too. Apparently, they hijacked that. This big money making company, grossing about $100,000 a year, was purchased probably for $1.50 by a company called Arthur J. Gallagher and Company, which is a multi-billion-dollar insurance firm. Which is too bad because I was going to sublease them some space here in the laundry room. So, okay.
Well, apparently they can get space from Arthur J. Gallagher now. Arthur J. Gallagher has a market cap in the billions. It's a publicly traded company. But what's funny is I looked at Arthur J. Gallagher's website and the information about them, and it turns out that they are considered one of the world's most ethical companies by a company called Ethisphere that also considers Ameriprise one of the world's most rated. Ameriprise is one of the world's most ethical companies. And get this, ready? Ethisphere is a for-profit company that for a fee defines and measures corporate ethical standards for you.
That makes it easier to award them if you're the one defining them. Sure,
apparently, it sounds a lot like you pick your ethical standards, and we will make you meet those ethical standards.
And it doesn't matter if you have a disciplinary history. It doesn't matter that you've been fired for allegations of misconduct or sanctioned by regulators or barred from the industry or your license have been revoked. None of those things really matter. What matters is here's the set of ethics we've decided on, and yes, you meet those qualifications. By the way, don't forget to send us your check.
Yeah, exactly. And it's so funny because they use these things to give themselves credibility with clients, and you'll find the most credible firms. And I went and did a search of a number of firms that I believe are highly credible, 100% fiduciary advisor firms. And not a single one of them says as seen in or as featured in on their website.
You wrote a book, though. Did you actually write it? Because there's this company here, and part of the article says that for $15,000 to $25,000, they write the book for you.
Yeah,
Did you write that yourself? We're going to call this guy.
I remember it was over the
Nick
summer.
Nanton. I know.
I sat in an RV and wrote it. And
yes.
Well, or you could write a supplement.
Yeah,
though there were a couple of books that for a fee you could write a supplement and get copies of the book. We've been offered these deals.
Well, and I wrote a foreword, as you remember, for one of Larry Swedrow's book that we bought a certain number of books for, but we don't promote it that way. It's Larry's book. I just wrote the foreword. That's all.
Right.
For a few of the books.
We don't do that, but some people would have done that. I guarantee you.
Okay, but the lesson learned from all this is, number one, to pick the right advisor, finding somebody through as seen on TV or being part of an ethics organ, that's not how you find a good advisor. Right?
No. It's hard to find a good advisor.
I know.
That's the problem. And there is no easy way to find a good. I wish there was. I truly wish there was. That there's this easy way to do it. But the government keeps trying to hold the industry to a higher set of standards. And the industry kicks, screams, lobbies, and sues. To the tune of hundreds of millions of dollars or more.
Because it's going to cost them billions.
To keep this from happening. So here's the problem. This is a problem around the world. You end up being the final arbiter. So you have to use your good sense. And I know so many of us are missing that these days.
But to start, there's a few things you can put to your advantage. Number one, 100% fiduciary only.
But how do you figure that out?
You got to go look at their ADV. Make sure they're not duly registered. They've got to be 100% fiduciary because that eliminates so much of the bad stuff.
Because again, it gets complicated. 100% fiduciary advisor. That means they're only registered with the SEC. They are not registered with FINRA.
But
What about insurance?
No, you can't. Because if you work with anybody who's in the insurance business, that's the same thing. You could end up in a poor product, be sold something. You don't want to be sold anything, period. Creates conflict.
Okay. What else?
It's not easy. You're right. Well, that would be one. Number two, and this is where it really gets to be more gray, because I truly believe that if you hire anybody other than somebody that's saying get what the market returns are based on academic principles, it's a bunch of hocus pocus. And I know Halloween just ended, but it really is, because the rest of it is what do you call it? You always have
mumbo jumbo,
whatever it is. Alchemy.
Garbage?
That's the word I was looking for. I mean, because it is. You can't base it on any evidence.
Right.
So that would be two. I mean, I guess the other one would certainly be in terms of, you certainly wouldn't never want to, you want to go to either FINRA or advisor.sec.gov advisor info, and make sure they do not have any of these issues. You want to hire somebody that has no disciplinary history, period. There's no reason to hire anybody who does.
Right. And you can check the disciplinary history. The easiest way to check actually anybody out. And this, I'm going to save you a lot of trouble, because we used to send people to advisorinfo.sec.com or .gov, which is so confusing and complicated. But the good news is FINRA and the SEC have kind of sort of merged their databases at brokercheck.com. So you can go to BrokerCheck and you can type in the name of an advisor or the name of a firm. And I do this all the time. As a matter of fact, I'm on BrokerCheck right now.
One of his favorite things to do.
So let's type in Thomas C. Koch. Thomas C.
Check, make sure he's still alive for one thing.
Well,
and
actually, I think they check that too. Thomas Charles Koch Jr. Look,
and
he works for Appella Wealth.
Oh, okay.
He works for Appella Wealth, and he is just an investment advisor. It says IA, investment advisor.
That's
okay?
it? Oh, man.
That's all it says now. Okay. Right next to Thomas C. Koch is Thomas P. Cockrell. Or there's there's Thomas C. Cook.
Okay. Does he look better than I do? Maybe we should go with that one.
Thomas Cook is with Merrill Lynch, Pierce Hunter, and Smith.
Okay. Yeah.
It has a B and an IA. The B means he's a broker regulated by FINRA. The IA means he's an investment advisor. So he is
that gets the bottom line.
Duly registered.
Correct.
That's how you figure this out. And then you can look, and this is very interesting. You can look and see that Thomas Cook has no disclosures with FINRA. Now, to find out if there are any disclosures for Thomas Koch, you need to click and go to the SEC site and check there, where they'll be listed there. Because now you split up. But if you look down here, you'll see there's a Thomas Coakley who is, he's with Vanguard. Does he have disclosures? Yes, he has disclosures.
Really? Vanguard.
And you can look down,
to hear.
And there was a customer dispute. Now, but was it a legit dispute? You can read the dispute. It said the client alleged that the advisor did not follow instructions. The advisor reviewed the investment recommendations and the tax implementation plan with the client. The firm found that the plan was appropriate and consistent with so nothing happened. It was a complaint, but even if there's a complaint and the complaint comes out in the advisor's favor, you still know there was a complaint made.
Fair enough.
So go check people out. Go to brokercheck.org. I think they even have .com too. And look them up.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And we want to provide all the help we can on this show to all of you to get you on the right track without all of this confusion, to help you find the easier path to the kind of wealth you need in retirement. Not wealth like you're going to be rich like Elon Musk, but the kind of wealth you just need to enjoy a comfortable retirement. We want to help get you there, but we're not going to promise you any fancy strategies or complex concepts. It's common sense. 855-935-TALK is our phone number. 855-935-8255. The call is absolutely free, and we've got lines open for you right now. And we've got a call from Michigan. Scott, welcome to Talking Real Money.
Hi, Tom and Don. How are you tonight?
Good, thank you, sir.
Doing well.
Sorry. Thank you. Hey, I recently became semi-retired, and now I'm looking to take some cash and create some monthly income from it. And I was looking at the iShares, the bullet shares, but I wanted to kind of get your opinion on things. I mean, right now I have cash that's sitting in Charles Schwab's, money fund that's earning, 4.79%. And that's good, but I know that interest rates will go down and that will change. Is there another, a fund like a Vantas fund that might be like a fixed income fund that can, or something different outside of bullet shares? Or I was just kind of looking for your opinion on the bullet shares, or some easy path to create monthly income.
I first thought you said bonds. I was like, because I think the new issues at like 3%.
3%,
no,
yeah.
iShares.
Okay.
No,
iShares. No,
for iShares. Yeah, the bullet shares. Bullet shares are from Invesco.
Yep.
And it's a bond laddering product.
Why don't you explain what that means?
Like those products?
Pardon me? No, I said it's a bond laddering
Why don't you
product.
Explain what bond.
I am not opposed to these products because I think because they're ETFs, the expense ratio is reasonable.
Right.
I like the idea of bond ladders. You can pick your bond ladder maturity with of various ETFs, and so no, I love the idea of laddering because it takes that guesswork out. Yeah, and the expense ratio is only 10 basis points. Pardon me?
Okay. And when you talk about laddering, I'm not laddering like the individual maturity dates, right? They're doing the laddering for me.
They're doing it all for you.
Yeah. For 10 basis points, it's pretty cheap.
Yeah.
Here's the thing. What do I expect to be better? I mean, over the long haul would still be the right mix of stocks and bonds and then rebalancing every year or every 6 months and taking money from the things that went up and living off that. That I still suspect will be a better long-term strategy.
Yeah, and I didn't get to go to the downside of the bullets. And there is a major downside, and this is why I love the idea of laddering. And I love the low fees of the bullets. But the bullets do something that I am, and I think Tom would also be opposed to. And that is they stretch for yield.
No. And by the way, if you just look at what's happened lately.
Triple B securities, 60% of the portfolio.
Look what the bond market's done in the last 2 weeks. If you're not concerned, I mean, it has been an uproar here, right? Because it looked, you said rates are going down. Rates have done anything but here recently. Because there's a lot of anticipation, not just about the election, but about the debt and / deficits that we're running in this country. So I wouldn't count on the fact that that's going to be the best performing strategy for the next few years because I just don't know.
Yeah.
Okay,
again, I love the idea.
Strategy?
I love the idea. I hate the execution. One of the if you're going to build a ladder, if you want to build a ladder, I would, and I don't know anybody else who has this service, but Schwab has a service whereby they will help you build a ladder of actual secondary market CDs or brokered CDs. Brokered CDs, where you can build a ladder of 100% safe CDs. And you'll own those individual CDs. I would rather see you do that because, one, I know the costs are going to be far lower, even though that 10 basis points is very low. But what you're getting is that absolute security. And we believe a bond portfolio does not exist for yield. A bond portfolio is part of your portfolio for stability. And that's why we believe the bond portion of your portfolio should be very, very close to non-volatile, at least risk-free.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
We've been doing this for so many years, Tom and I, talking on the radio, talking on podcasts, trying to help you manage money. And we just keep getting older by the day, but we still enjoy doing it. As a matter of fact, I got to tell you, for those of you who just tuned in or listening to I was in the hospital for a few days to be observed for an AFib thing. I don't have anything seriously wrong. And I got to tell you, I don't think I can ever retire.
You didn't like it?
I hated it. I
know.
Hated
You're
it.
calling me from the hospital.
I was so bored. I don't want to just sit and watch TV. They go, just watch TV. I went, no, I don't want to watch TV.
Plus, there's a lot of commercials on TV.
Unless, of course, it was on the Vision Pro my wife's going to give me for Christmas. Then I'll watch TV. But anyway, no, we love doing this. We love talking with you. And we love it when you call us at 855-935-TALK on Saturdays. But we also love it when you send questions into us because it gives us an opportunity to answer them on other podcasts like the Friday show, which I didn't do this week because I was in the hospital.
You had a good reason.
I'm sorry. I'll catch up next week. But we get a lot of questions. Some of them get spoken. I answer those on Fridays, unless I'm in the hospital. Or we answer them on this show or other podcasts. And do you have any of those?
I got some. Yeah, I got some. Yeah.
He does. He has some questions. Look at that.
I know. This actually comes from right here, Renton, Washington, from Ted. Ted writes, why doesn't Appella, that's the company of which we work for and are partners in, create exchange-traded funds based on risk tolerance scores, and all rebalancing occurs in the ETF each year? I have a risk score in the mid-80s, so I would select Appella R80. Hypothetically, a person with a 0 risk score would pick Appella R10, and a person with a risk score of 48 would pick Appella R40 or 50. Rebalancing work is done within each exchange-traded fund, so each investor doesn't need to rebalance anymore. Seems logical and much easier than picking an ETF method, as currently it would be easiest for do-it-yourself investors. So what you just said, you didn't want to retire. Here's your project. Build some exchange-traded funds that allow people to pick one fund. Boom.
You know, I would actually really, I'd love to see some of that. DFA,
well, okay, there is some
DFA,
of that,
dimensional funds
used to date fund.
Target date funds, but DFA, well, they have mutual funds that do this.
They still have
at certain, They don't have ETFs, I don't believe, though.
No, not yet, not in this product, but eventually they probably will.
And I can't think of anybody who has an ETF that is a 10% stock, 20% stock, 30% stock, 40% stock, 50% stock.
But you could find that though with a target date fund. Target date fund, sure. There's target date funds that are exchange traded funds.
I'm trying to think.
I'm sure Vanguard has the same thing in their.
I'm trying to think of who has the target date.
Okay, Ted. First of all, just to be completely honest here, to start an exchange trade, we do not have, and we use products from people like Vanguard, Dimensional, Avantis, because it's a lot of money to start an exchange traded fund. We've watched this, by the way. As Avantis, the folks there left Dimensional funds and went to American Century. They had to have American Century's backing, really, to make it happen, even though the work that they do is very, very good. It's low cost. But it's a major deal to register a new exchange traded fund, put it together, manage it. There's a lot of work. And even though Don would like to keep way outside our scope, and again, even though the company now manages, I think, somewhere around $5 billion, which sounds like a lot, we're still a small company in a big picture of the world today. There's a lot of companies a lot bigger. So,
and here's the thing: if there was going to be such an ETF, I would want to see it come from Dimensional or Avantis, so that you got the small value tilt.
Yeah, the tilts.
There are exchange traded funds that are kind of target date. iShares has them, but if I remember, hold on. No, not iShares, Spider, S&P. They have some, but they're active.
So they're not a passive or
they're
rules-based.
Yeah, they're not.
Interesting.
I'm really having a hard time thinking of any. Now, maybe my brain's damaged from the hospital.
Or if you manage one, please call us. And tell us, is your chance to promote your product.
Let's see what these BlackRock iShares look like. I've never looked at them before. Target date ETFs. Okay, BlackRock has them, but they're straight index.
There's no
the life path
overlay.
Okay, I forgot about factors. The life path target date funds, but they're not doing any of that tilting of asset classes and the like that we like. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
kind of hope Avantis will create a fund like that, or DFA, or an ETFs like the
so
10.
A tranche of 10%.
Yeah, 10, 20,
bond, 90%. Yeah, sure.
I'm looking at
easier.
this. I'm looking at this iShares 2025. What's it called again? Hold on. Life Path. Target date 2025.
Yeah, I've heard of those. Yeah.
Yeah, and the portfolio's funky. It's really, really weird.
Let me guess. 40% U.S. large cap growth.
No, it's okay. It's 40% stock, 60% bonds.
Ah, okay.
Okay.
Well,
and that's where
case,
they end. That's as conservative as it gets. That's where it stops. So you're always going to be a 40-60. You don't get more conservative than that, which means you don't have that additional fine-tuning available to get you to a lower equity ratio. It is of the total, the 100% in the portfolio, 26% is in the Russell 1000.
Okay. Large stocks.
But get this.
Yeah.
0.3% is in the Russell 2000.
That's weird.
Yeah, wait.
Smaller companies.
Less than 9% is in international developed markets. 4%, less than 3.5% is in emerging markets.
Well, those two ratios to each other are fine, but overall, that's too light in international.
And then we have 1% in global infrastructure. Where did that randomly come from?
And what does it hold? I mean, is that like bridge builders in Taiwan or something? I mean, that doesn't make sense.
It's global. So
strange.
I truly do not know. But again, that is actually a really good idea, something that Appella couldn't do, because it requires vaster resources than we have available to us. It's very expensive to set up an ETF. Very expensive.
And that's why Avantis, as I was saying, really had to have American Century behind them. To go out and do this on your own, basically impossible. There have been two people, by the way, that recommended Tom and Don have their own ETFs as well.
I'm not going to pay that kind of money. Two people.
No.
Yeah.
I do want to mention, speaking of money, a couple of things here. If you're saving for retirement, you did get some good news this week. You can save more in your employer-sponsored plan next year and in your IRAs. Increases of about $500. Not about, of $500. So old guys like you and I over 50 could put $31,000 into our 401ks next year. Younger people, you kids under the age of 50, $23,500. Here's the weird part. Remember, this is the year that they start if you're between ages 60 and 63, you can add another $11,250 to your retirement plan next year, your accounts. Because you're between the ages 60 and 63.
Why? Where do they come up with that?
It's so, speaking of random, I mean, it's like, well, okay, what about people that are older than 60?
I'm 68. Nope. Can I put some more in? No.
Nope.
Why not?
Nope.
It's not fair. I'm sorry, I feel discriminated against.
Because this is the U.S. Congress. That's why.
What idiot came up with
Literally
that
makes
idea?
No sense. I don't know. 60 to 63. So if you're in that range,
must have been a group, a little subgroup at AARP that said, "We want more.
We have to have this.
We need a bigger tax
for you
break."
people. Yeah.
I found out what your infrastructure ETF is.
Oh,
it's a combination of construction companies and utilities and energy companies.
Globally,
yes. There you go.
Yeah. So it's not just Bechtel or something, some other firms.
Our phone number is 855-935-TALK, 855-935-8255. Give us a call. We've still got time left in the hour. Not a lot, but some. We'd love to hear from you. But we also, do we have another question or not?
I do have other questions. I do want to mention, just to close out the contribution limits.
Oh, there's more in the contribution limits? Is there a carve-out for 68-year-olds?
No, there's not, actually. They don't think about you at all anymore. I hate to break the news to you.
I'm forgotten.
Off the list. No, it's
you were going to do the show without me?
Between 10 and 15% of people that save, that max out their 401k, 403b, et cetera. It's still a pretty small number. So we mentioned these maxes, but there's very few people that are maxing it out.
So there's no point in mentioning them.
Just throw that in there.
Well, so therefore, why are we mentioning them?
I don't know. I just trying to write the program. I was supposed to be the starter this week. I had a whole thing figured out, all written, and then they blew me out this morning.
No, wait a minute. Okay, there's 10 minutes left. You just take it over. Go ahead.
Okay. All right.
I'll just sit and watch. It'll be fun. It'll be fun to watch.
I think you can answer this question far better than I can.
Okay.
So I'm going to need you. It comes from Southfield, Michigan. Jason writes, I recently inherited a portfolio containing over 100 blue chip stocks, and I'm seeking guidance on how best to evaluate these holdings. Can you recommend a sound methodology for assessing the value and potential of these stocks? I understand your perspective on individual stock ownership. Yeah. Maybe not, or you wouldn't be asking us.
Yeah,
However,
exactly.
I prefer not to liquidate everything at this time. If possible, could you suggest any free online resources that provide reliable information or recommendations on whether to hold, buy, or sell these stocks? Short answer to the last part, no.
Nope. No.
The first part, there are x-rays where you could go look at the stocks to tell you whether they're large, whether they're small, whether they're value or growth. You could do that.
You could.
We wouldn't
why?
recommend it. No. You should sell these and own a diversified portfolio. Why not? Right now, you're getting a step up in basis if this is a recent inheritance.
Hold on. Okay. Oh, that's true. So that's the only fly in the ointment would be whatever the tax situation is. Exactly. So if these are all inherited,
there's not going to be much.
But it could be an inherited IRA or something, but it's not. They're inherited stocks.
It just says stocks.
Okay, because see, I want to just think if it is an inherited IRA, then you have to do some tax planning. But if it's just inherited shares of stock, then unload the entire because there's a huge tax advantage, as Tom said. If these are just inherited stocks, you will have little or no capital gain.
And what I'm hearing, though, from Jason is the wrong questions are being asked.
Oh,
the question is,
questions.
Like, are any of these stocks great? Should I own them because they're going to do well in the future? Well, nobody knows that. Are any bad because I need to be unloaded now because they're the next whatever corporation?
Enron?
Nobody knows that. Yeah, nobody knows. There is no methodology for seeing the future. You can see, again, whether these are big companies or smaller companies, whether they're considered growth or value. That would be easy to determine, but not on whether you should buy, hold, or sell them. No.
Yeah, 5 years ago, let's use a local stock again. Pick on them again. 5 years ago, a lot of experts would have said Boeing is a great company. Hang on. They're not going to lose 50% of their value anytime in the near future. Well, they've lost almost 50% of their value in less than a year.
And look at the situation that they were in, and it's still in some cases. I mean, the number of planes needed for all of us to continue to fly is a lot. Number two, Boeing does have, and I hope they don't get rid of this, but they may, the defense part of their practice, right, where they sell this stuff to the government. And now they're still in space. There's diversification in the business. But you're right. When the future looks great for a company, there's a lot of other things going on you have no idea about, nor does anybody else.
And there was no way that you could have known that they would have all those accidents. There was no way you could have known 10 years ago that a little upstart run by a crazy South African named Musk would come along and turn upside down the entire the entire global space industry, and make Boeing look like a bunch of dopes when it came to space flight.
Yeah. They've really, that's
so
not been
look
good.
at the stocks in your portfolio. I can tell you a negative potential story about any one of them, and I can tell you a positive potential story about any one of them, but nobody knows what the future is going to bring for any of those companies. Therefore, the best strategy is to unload them all and own 13,000 in a diverse
Tom
portfolio.
and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And remember, go to talkingrealmoney. What?
Don't forget to start the washer when we're done. I was reminded of that before the show.
Are you seriously supposed to turn the washer on when we're done?
It's all loaded. Everything's.
His wife came in and said, "Yeah, you're in the laundry room. Get out of the way and turn the washer on."
Well, no.
I have a little bit of interesting news that I want to share.
Please.
Little thing from Vanguard. Since we have so many Vanguard clients who listen to us. I mean,
absolutely.
Wow, a lot. Sure. For years, Vanguard has been saying, "Hey, transfer over to our brokerage platform because we're going to end the mutual fund thing eventually. You won't be able to have just mutual fund accounts anymore." Well, at the end of next year, 2025, there will be no more mutual fund accounts at Vanguard. Everybody will have to be.
That could piss off more people.
Oh, I know. They are not going to be happy. In 2022, they started charging $20 per account per year for the legacy account. But as of the end of 2025, you won't be able to pay $20 a year. You will have to. You're going to have to move it. They don't have any choice.
I know.
You have to move it.
It's too bad.
Yeah, and so you might as well get it done
now.
Yeah.
So move it to the Tom and Don 10, 20, 30, 40, or 50, or 60, or 70 exchange traded fund.
Can you check with some of your friends at Avantis and see if we can do the Tom and Don 10, 20, 30, 40, 50, 60, 70, 80, 90, 100? No?
Because I don't want to hear the giggles. I got enough people laughing at me for enough things. I don't need to add to it, so I'm okay.
Including all those people in the Midwest who think your jokes are funny. Yeah. Go to TalkingRealMoney.com if you would like to learn a lot more about how investing works and can work better for you. You can also find out there, go to TalkingRealMoney.com/help, and you can learn how to find a reasonable 100% fiduciary, reasonably priced advisor. And boy, they're hard to come by. If you think your advisor's looking out for your best interests, well, think again, because you're probably wrong.
And did they say as seen on TV about me on there?
No, I looked. There is no as seen on TV.
And your book, they put that?
Nope. They don't care about us.
Hurts. No.
We're an afterthought.
I can't even say top 20 podcast on Amazon because it'll make me edit that out. So I guess I won't even put that.
We're not a top 20 podcast on.
Well, we were among the top 20 investing podcasts recently when I logged
on Amazon. We were among them recently. Yes. That's good. I think that qualifier.
I don't think so.
No, I think it is.
Okay.
I think it is because you said we were.
Yeah.
Past
well, because I think it changes day by day. I don't.
It changes
every day.
minute by minute.
Yeah. Right. So thank you.
But we are a popular podcast.
We are.
I don't know why.
I was going to go there, but
and some of our complainers. Although we got a really nice review recently that said, nice podcast on crypto. We actually got a
We don't hear that a lot. Yeah.
No, we got a positive crypto comment, which really shocked me. Because usually it's Bob.
And they're not
Bob.
Friendly. Yeah.
Bob, Bob sends in 2 to 3 questions a week that don't get on the podcast.
Still,
he just says the same thing all the time.
Up on crypto.
Yeah, he just says the same thing all the time.
Well, it's going to be the world's currency. It is going to be an asset class that's going to be different than stocks. Oh, that's right. None of those are true. Anyway,
I'm going to boil up my hat and eat it if that happens. I will eat my hat.
Which one, the red or the greens?
Either. I'll do both. I'll have a stew. A melange.
Take advantage of all the free stuff at TalkingRealMoney.com. I got to start this. I got to go.
And start. Okay, Tom starts that. I'll finish the show. You can also send us questions there too. Just go to TalkingRealMoney.com and then click on the contact form and either speak the question or type it, and then we'll answer it on a future podcast.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.